Listen closely. If you've been watching silver inch higher, stall out, surge forward, and then get violently pulled back, like someone's yanking on your future in a never-ending tug of war, you're not imagining things. Something is tightening. Something is starting to crack. And the very people who normally keep this machine humming along smoothly are beginning to sound uneasy. Here's the part most people haven't fully absorbed yet. The silver price you see flashing on a screen is not the silver price the real world may soon be forced to deal with, and if the next shock hits the financial system the way I believe it can, price won't even be the first question. The real questions will be far more basic and far more uncomfortable. Can you actually get it? Can you move it where you need it? And can you prove that you truly own it? Quick favor before we go any further. My analytics keep shouting the same message at me. The majority of people watching right now aren't subscribed. If this kind of deep, no-nonsense analysis adds value for you, support what we're building here, hit subscribe, and drop a comment that says, "Our John A.G. Second." So I know you're one of the real ones riding with this channel. Now let's set the stage for what we're actually dealing with. We're watching silver trade in a zone that naturally grabs attention. Prices in the 90-something range, flirting with triple digits, pulling back, then pressing again. And that's exactly why the next move is so dangerous for the system that tries to control this market. A visible number like 100 becomes a psychological line in the sand. It wakes up people who haven't thought about precious metals in years. It forces institutions to answer questions they hate being asked, and it turns maybe later buyers into right now buyers. But if you think this story is just about a round number, you're missing the real film playing behind the scenes. The real story is about leverage. It's about promises layered on top of promises. It's about paper claims multiplying far faster than physical reality ever could. And it's about a supply chain choke point that, if squeezed hard enough, can make the entire global economy feel like it just slammed into a concrete wall. So in this video, I'm going to do three things. First, I'll explain why silver prices can rise even while the market itself remains fundamentally broken. Second, I'll walk you through the pressure points, derivatives, physical bars, and the wholesale pipeline that could flip silver from a managed market into an unmanageable one. And third, I'll connect all of this to the biggest geopolitical supply risk most people still underestimate, the advanced semiconductor bottleneck centered around Taiwan, and why that's far more than just a tech story. Stick with me until the end, because I'm also going to share my personal checklist, how I'm thinking about positioning, which signals I'm watching closely, and the single mistake I don't want you making if the market finally does what it's been threatening to do. And after you're done watching, check the description. There are bonus links waiting for you, including access to a premium WhatsApp channel and a membership option if you want deeper members-only breakdowns. All right, let's start with the illusion. If you've ever wondered how silver can trade like a liquid, efficient market while the physical world keeps whispering about tight supply, the explanation is actually very simple. Paper can be created without limit. Metal cannot. A promise can be duplicated endlessly. A bar of silver cannot be cloned. This is why markets overloaded with derivatives can look perfectly normal, until suddenly they don't. Derivatives aren't just side bets anymore. In modern finance, they've become the steering wheel. If enough paper is dumped into the market at exactly the right moment, it doesn't matter how many real buyers are waiting at a reasonable price. The screen can print whatever number the largest players need it to print, for as long as the system can withstand the stress. And that phrase matters. For as long as the system can handle the stress. We've already seen versions of this play out in other commodities where prices wandered into territory that made zero intuitive sense to everyday people. When the plumbing gets clogged, storage, delivery, financing, collateral, the price stops behaving like a discovery mechanism and starts acting like a panic gauge. It's no longer telling you what something is worth. It's telling you how badly the system needs to force certain behavior. Now imagine that same kind of stress applied to silver, a metal sitting at the crossroads of money and industry. Silver isn't just a store of value story, it's a manufacturing input. It lives inside electronics, solar panels, medical equipment, and countless invisible components of modern life. That means there are two kinds of buyers, people who want silver and people who need silver. In a crunch, wants can be delayed, needs cannot. So when you hear about massive daily trading volumes, understand what that really implies. If annual mine supply sits in the hundreds of millions of ounces, but the paper market can print claims equivalent to that supply multiple times over in a short window, volume alone doesn't prove liquidity. Sometimes it proves the opposite. Sometimes it proves the market is being used like a control console. Here's a simple way to picture it. Imagine a stadium. The physical silver represents the actual seats. The paper contracts are the tickets being sold. For years, far more tickets have been sold than there are seats because most ticket holders never show up. They trade the ticket and move on. But the day a crowd actually shows up, the day enough people demand seats at the same time, that's when the security lines turn into chaos. And that's when you discover what too many promises really looks like. Now I want to address something that makes people uncomfortable because it challenges narratives on both sides. You can have rising prices and still be in a fake market. A rising price does not automatically mean the market has become free. Sometimes rising prices are simply pressure leaking through cracks in the control system. It's steam escaping. It's the lid starting to rattle. So if silver pushes toward 100 and beyond, don't assume the system suddenly turned honest. Assume the opposite. Assume the pressure simply became too expensive to contain at the old level, so the range had to shift higher. That's how managed markets work. Control doesn't always mean pushing prices down. Control means steering outcomes into what's considered acceptable, and what's acceptable to the system. Usually a slow, orderly climb that doesn't trigger panic, doesn't spark a stampede, and doesn't invite uncomfortable questions about deliverability, which brings us to the physical side of the market. There's a disconnect forming that most people only notice when it's already too late, the difference between wholesale bars and retail products. Large bars feed the institutional pipeline. Coins and small bars feed the public. They're connected, but under stress they behave very differently. When industrial users get desperate, they don't line up for shiny retail products. They go straight to supply contracts, refiners, and large bar inventories. Meanwhile, the retail market can start acting strange. Premiums may temporarily compress. Dealers may grow cautious. Some quotes might look odd, not because silver is plentiful, but because holding inventory becomes terrifying when screen prices are whipping around violently. This is where people get fooled. They see softer retail premiums and think, the squeeze must be fake. No. Sometimes soft premiums are the market screaming, we don't trust this pricing mechanism right now. That's not abundance, that's fear. Now let's talk about the mechanism that connects paper markets to physical delivery, the exchange for physical style transactions where paper positions are converted into claims on metal elsewhere. You don't need to memorize the jargon, just understand the idea. When the home warehouse comes up short, the system reaches outward. It tries to source metal from the wider network. When that outward pull intensifies, it's often a sign of strain. It can mean the easy metal is gone. It can mean inventory is already spoken for. It can mean the market is shifting from available at a price to available if you matter. That's why I watch two realities at the same time. I watch screen behavior, how price reacts around obvious psychological levels, and I watch pipeline behavior, how metal is routed when obligations must be met. Now let's connect this to the chip choke point, because this is where things really heat up. A senior U.S. official recently warned that the single greatest point of failure in the global economy is the concentration of advanced semiconductor manufacturing. In plain English, a massive share of the world's most critical chips are produced in one small geographic region. And the global economy built its entire digital nervous system around that fact. If you think this is just about smartphones, you're thinking way too small. Those chips are inside vehicles, medical devices, industrial machinery, payment systems, defense infrastructure, and the just-in-time supply chains that keep shelves stocked and factories running, and we already got a preview of what happens when that flow is disrupted. Delays, shortages, price spikes, and ripple effects that travel far beyond the original bottleneck. Now imagine a real blockade or invasion scenario. Even without sensational headlines, just do the math. If the world loses access to high-end chips for months, global production slows, productivity falls, inflation pressure pops up in unexpected places, corporate earnings projections get obliterated, and a financial system built on assumptions of smooth growth and predictable settlement gets slammed with uncertainty, it cannot price. What happens to a heavily leveraged derivative system under that kind of uncertainty? It can't price. It tries to de-risk. It tries to unwind. And unwinding leverage is never gentle. This is why I keep saying the silver story isn't isolated. It's not silver investors versus stock investors. It's one interconnected machine. Chips are a pressure point. Energy is a pressure point. Currency trust is a pressure point. And silver sits right in the middle because it's both monetary and industrial. Let's take it one step further because this is the cliff most people don't see coming. If the system runs into a settlement crisis, whether from a major bank wobbling, a clearinghouse tightening rules, or a geopolitical shock freezing part of the pipeline, the thing we call price can become temporarily meaningless, not forever, but long enough to matter. Why? Because pricing assumes access. It assumes collateral can be posted. It assumes counterparties can perform. When those assumptions break, markets pause, spreads blow out, and the only question that matters becomes, what will the real world trade right now, in hand, with no promises attached? That's when physical metals start behaving very differently than paper claims. And before someone says, but banks are too big to fail, let's be honest about what that phrase really means. It doesn't mean they can't fail. It means their failure creates consequences the system wants to avoid. Avoiding consequences usually requires printing, backstopping, rule changes, and emergency measures. Those actions can keep doors open, but they come at a cost. Confidence. Confidence is the true currency. Fiat systems are trust systems. They function because people believe tomorrow will resemble today. When that belief cracks, people rush toward anchors, things that don't rely on someone else's promise. Land, energy, food, and yes, metals. I'm not here to sell fear. I'm here to give you a map. So let's talk about what I'm watching inside the silver market itself and why the next few months matter. First, open interest and positioning. When price rises, people assume shorts are fleeing. Sometimes total positioning barely changes, which can mean the pressure hasn't been released. It's just been shifted. Short exposure can move, hide, or roll, but the risk can still sit there like a compressed spring. Second, delivery behavior. Active months versus quiet months can reveal when the system expects heavy demand. But what really matters is surprise demand, when supposedly calm periods suddenly see unusually large claims on metal. That's a smoke alarm. One alarm doesn't mean the house is gone, but it does mean you check the kitchen. Third, refinery capacity. When refiners are booked out, when product flows slow, when melt is redirected to fulfill large bar demand, the retail layer can get starved even as headlines remain calm. People misinterpret that. They think scarcity at retail means low demand. Sometimes it means the biggest players are being served first. Now here's my skeptical counterpoint, because I promised I'd challenge at least one popular narrative. A lot of silver commentary assumes that in a crisis, silver instantly snaps to gold parity or explodes overnight. I appreciate the enthusiasm, but I don't base decisions on overnight fantasies. Markets can overshoot, ratios can swing violently, but the path can be ugly. The system will fight, rules will change. Volatility will be used to shake people out, so don't anchor your strategy to a magic number. Anchor it to structure. The structure is simple. Silver is essential, and the paper market is massively oversized relative to physical supply. That mismatch is where both the opportunity and the danger live. Let's make this practical. If you're holding silver, the game isn't staring at the screen and panicking on every dip. The real distinction is between trading and owning. A trader obsesses over timing. An owner focuses on possession and patience. If you need cash for real life, do what you must. But if you're thinking about selling just because of a headline or a price milestone, ask yourself an uncomfortable question. What are you selling into? A system with stable purchasing power, shrinking debt, robust supply chains, or a system quietly trying to manage decline without admitting it? You don't need to be a doomsday thinker to see the trend. Everything is being financialized, tokenized, sliced into collateral, and traded as abstraction. That can inflate asset prices, but it also creates fragility. More abstraction means more failure points. That's why I keep returning to simple logic. If you want silver exposure, prioritize physical, you can access. I'm not telling you to ignore all paper instruments. I'm telling you to understand the hierarchy. In calm times, paper tracks. In stress, paper can become someone else's problem. That brings me to a question for the comments. If silver breaks and holds above 100, do you think the public rushes in, or does the system slam the brakes first? And another one. What's your personal trigger to add more? Price dips, supply shortages, or a macro shock like geopolitics? Let's revisit the retail trap, because this is where people get emotionally wrecked. You may see moments when dealers bid below spot or quote wide spreads. People call it manipulation. Sometimes it's survival. In high volatility, holding inventory can be lethal. So spreads widen, bids fall, offers rise. That's not proof a squeeze is fake. It's proof the market is unstable. And instability is exactly what you'd expect when a paper-heavy market starts encountering real physical demand. Here's something many silver scripts ignore. Industrial demand isn't optional, it's evolving. Solar expansion, electrification, and defense spending all pull on silver supply. Politics aside, the math matters. If industrial demand grows while mine supply struggles to keep pace, the market tightens naturally. No conspiracy required. And remember, silver supply is often a byproduct of other metals. That means silver output doesn't always respond to silver prices. If copper production slows, silver byproduct slows too, even if silver prices scream higher. That delayed response can intensify squeezes and explain why short-term predictions fail while long-term trends become obvious. Now let's talk about the uncomfortable truth of modern banking, rehypothecation. Assets pledged, repledged, and treated as if they exist in multiple places simultaneously. It's like renting the same apartment to 3 tenants because you assume they won't all move in at once. Most of the time they don't, but when trust breaks, everyone shows up. That's why geopolitics matter. Not because geopolitics magically changes metal value overnight, but because shocks compress timelines. They turn someday risk into today risk. And when today risk hits a leveraged system, leverage unwinds. In a chip shock, you can see risk-off selling in equities, stress in credit, and a frantic hunt for liquidity where institutions sell what they can, not what they want. That can cause temporary dips even in strong assets. That's why you need a plan. Dips during crises don't always mean you're wrong. Sometimes they mean collateral is being scraped. So if you see a sudden smash lower, ask the right question. Is this liquidation or a real change in fundamentals? Physical availability doesn't change overnight. Paper flow does. Now let's talk about the most underappreciated factor in this entire story. Timing. Every market has calendar stress. Certain months concentrate settlement. Certain windows move inventory. Certain reporting cycles shape narratives. Combine that with geopolitical risk and you get a setup where an ordinary day can turn historic without warning. I'm looking at the next quarter as a pressure cooker, not because I can name the day something breaks, but because multiple forces are aligning. High leverage, high uncertainty, tight industrial demand, and magnetic psychological price levels. Behavior matters too. When silver crosses a visible level, the public doesn't behave like institutions. The public behaves emotionally. They chase. They fear missing out. They overwhelm the same dealers and products. That's when the retail layer breaks first. Then come the shortage headlines. Then the same people who ignored silver for years demand delivery tomorrow. That's when premiums explode and delivery times stretch. And that's when people learn you can't compress a supply chain just because you feel urgent. That's why boring is smart. Build positions before the crowd arrives. Focus on possession. And to be clear, I'm not telling anyone to YOLO rent money into metal. I'm saying stop thinking in extremes. Think process. Think layers. Think resilience. Quick creative plug here for those who love proof. If you want real silver success stories, regular people who stayed disciplined and later thanked themselves, there's a link in the description to a separate channel focused entirely on those wins. Go check it out and subscribe. Those stories help keep your head straight when volatility tries to mess with you. Back to the main thread. Yes, the system can change the rules. It has before. It will again if needed. Margins can rise. Trading can be restricted. Delivery terms can shift. Cash settlement can be nudged. Narratives can be deployed to make it sound like it's your fault for expecting normal behavior. Your defense isn't outrage, it's preparation. Preparation means knowing what you own, why you own it, and how you'd respond to 3 scenarios. A slow grind higher, a violent smash lower, or a sudden freeze where markets stop acting like markets. Another overlooked angle is real rates and liquidity cycles. When inflation outpaces yields, real returns on cash and bonds turn ugly. That pushes capital toward alternatives, commodities, hard assets, dividends, and precious metals. Even if yields look high on paper, eroding purchasing power changes incentives. And capital flows matter because silver is a small market. A tiny reallocation from massive pools of money can move silver violently. That's not hype. It's math. A chip shock can be inflationary and recessionary at once, forcing policymakers into ugly trade-offs. When policy gets messy, currency confidence gets messy. And when confidence wobbles, hard assets start looking like insurance instead of speculation. I'll be transparent about my bias. I view physical silver as a form of sovereignty. I like assets that don't need permission, that don't require a login, that don't vanish when a counterparty fails. I accept volatility as the cost of independence. And for this community, one more thing matters. We're pushing back against copycat channels flooding the platform with recycled content. If you want to support original analysis, subscribe and comment. Our John A.G. That single comment helps more than you realize. And remember, the description has bonus links, including the premium WhatsApp channel and membership options. Now, what do you do today? Step 1, audit your exposure. If all your silver is paper, understand that risk. Step 2, avoid perfection paralysis. Waiting for the perfect dip often means missing the move. Step 3, think about storage and documentation. If you own physical, treat it like you truly own it. Step 4, diversify resilience. Silver isn't everything. Food, skills, community, and sane cash buffers matter too. And I want to invite something powerful. If you've had a win, paid off debt, built a position, stayed disciplined, share it in the comments. Your story could be someone else's spark. Now back to mechanics. If the system is forced to deliver more metal than it wants to, its options are limited. Find metal, encourage cash settlement, or change the rules. None are clean. That's why unusual delivery behavior during quiet periods matters. Pressure isn't waiting politely. So what is silver really worth? In a free market, Very different than in a heavily paper-levered one. I won't pretend I can print the exact number, but I can outline the forces: industrial necessity, monetary distrust, and leverage unwinding. When they align, moves get violent. The silver market is narrow, narrow markets gap. One last skeptical note. In a crisis, silver can dip before it rips. Liquidity events force selling. That's why over-leverage is dangerous. Stay solvent, stay calm. Zooming out, this is about control. Systems that create unlimited currency try to steer behavior with prices and narratives. When trust fades, new slogans and new tech appear. Some innovation is real. Some is control dressed up as progress. I don't hate technology, I just don't confuse it with freedom. Freedom is the ability to opt out. Physical assets are one way to do that. If you want deeper research, that's why we offer members-only videos with heavier analysis. Check the membership link and bonus resources in the description. Now let's land this. What we're watching is a market pulled in two directions. Paper pricing can shove numbers around. Physical reality keeps tightening underneath. Paper often wins days. Reality wins decades. At a geopolitical chip choke point, and uncertainty spikes, leverage unwinds, and trust gets tested. When trust cracks, hard assets stop being trades and start being lifeboats. Here's the cliffhanger. If a major shock hits while silver is already hovering near a psychological breakout, the rush for physical could move faster than most people can react. The crowd doesn't move early, it moves all at once. The decision window isn't when prices are higher, it's before shelves are empty. If you want me to keep tracking delivery stress, retail premiums, and macro triggers, hit like so YouTube actually shows this video, and subscribe because updates may come fast. Final question for you. If you could ask one honest question about silver that nobody answers straight, what would it be? Thanks for watching. Take care of yourselves and each other. This video is for educational purposes only, not financial advice. I'm sharing how I think and what I watch. Your money is your responsibility. Do your own research and make decisions that fit your situation.